Stan and Mindy Miller have done everything right. They're 62 years old, living in Ohio, and steadily working towards retirement for decades. Both worked at corporate jobs. And between the two of them, they've accumulated about $1.8 million in retirement savings. Their plan? Retire together at 64. Travel while they still are healthy enough to enjoy it. And stay in the home that they lived in for nearly 20 years. They want to replace their cars every so often and hopefully at the end of it all, leave a little bit behind for their 2 kids. They're happy with how their investments have grown over the years, but the ups and downs of the market are starting to stress them out. The thing that served them so well, now it threatens to quietly undo all their work. But we can change that. Today, I'm going to show you exactly what that vulnerability looks like in their plan, using real financial planning software. And more importantly, I'm going to show you how to protect yourself from it. So let's get into it. So here's Stan and Mindy's current plan in RightCapital. You can see they have investments totaling right about $1.8 million. Split up here between their 401ks, and they have a joint brokerage account too with about $150,000 in it. They're planning to retire at 64. And on top of their mortgage, they're spending roughly $6,000 a month. That puts their total annual spend right around $100,000 a year. They want to replace their car every 7 years, and they're saving 12% and 10% into their 401ks. Not bad. With the match, that means it's about $39,000 a year. They might be able to do a little bit more. So if we run their plan in the simulation and take a look at where they're currently at a 70% probability of success. Now, what that means in plain speak is that more times than not, they're going to be okay on their current course. But if things don't go right in the market, they could be in a lot of trouble down the road. And let me show you what I mean here. So I'm going to run what's called a stress test. And we can run these types of tests for all different scenarios here. Things like higher taxes, reduced Social Security benefits, increased longevity. But today we're focused on what if the market takes a turn for the worst right before or after their retirement. So their baseline plan, if you remember, is at 70%. And if the market drops by 20% right before or right at retirement, their plan drops to right above 50% probability of success, which just means they have a coin flips chance at making their money last without making any other changes to their plan. So why does that happen? Why does a single market downturn have such a devastating impact on their plan? Well, it's called sequence of returns risk. When you're saving for retirement, it doesn't matter the order of your investment returns. A bad year early on, it can get smoothed out by a good year later. But once you start withdrawing money from that portfolio, the order that you receive your returns, it matters enormously. If you have to sell when the market's down, those shares, they don't get to participate in the subsequent recovery. And a bear market isn't just some rare edge case. According to Fidelity, the S&P 500 has dropped 10% at least every other year. And since World War II, a bear market or a 20% drop has happened on average every 5 years. So that's a 20% chance every year. Now, if I switch over to the retirement details screen here, I'm going to click through the software. Let's take a look at the stability of their income. All right, so I've clicked over to the retirement details screen in their plan, and I want to take a look at the stability of their income with you real quick. So you can see everything they need to pull or everything they need to spend in retirement here is indicated by the bars just based on years across their plan. The blue indicates what income is stable. And in their plan, the only source of stable income is Social Security, and it represents 35% of the money they need across their total plan. The rest of it, indicated in orange, well, that has to come from withdrawals from their portfolio. And that portfolio is going to be subject to market volatility. Let's take a look at their cash flow maps and for a few specific years and show you what's happening here in the background. So we're looking at 2029 first. This is a full year early in retirement where they're not purchasing a car, so it's more of a standard year. You can see they have no income coming in on the left-hand side. And although they were spending $100,000 a year before retirement, their expenses have increased up to about $127,000. And that's because of the introduction of these healthcare costs and their new travel budget. So all told here in 2029, they're looking at a net deficit of about $137,000, and it's got to come from somewhere, and that somewhere is going to be their portfolio. Now let's jump ahead to 2036. Now you can see they have a little bit of income coming in here from Social Security on the left-hand side. Still not enough to cover their full range of expenses over the right-hand side here. They're still running about a $52,000 deficit across this year. Still negative, but more manageable. And finally, once we get out here to 2040, this is after their required minimum distributions have started, and they still have that Social Security income too. Their net cash flow has turned positive. So we have about a $26,000 surplus across this year. Now, if you like seeing these retirement plan tools in action, hit subscribe for me. It would help me out a lot. So you can see how the early years of retirement are by far the most demanding on their portfolio. We have a problem. High portfolio withdrawals in the early years of retirement, right when they're most vulnerable to the market downturns. Now, there's different ways that they can hedge against this risk. Some people, they might choose to work part-time in those early retirement years. Even a little bit of income, like $30,000 or $40,000 a year, can dramatically reduce the pressure on a portfolio. But the Millers don't want to do that. They want to focus on traveling and spending time with their grandkids. So we need a different approach. So what can Mindy and Stan do about this problem? Well, let's look at one option. We're going to switch over here to their investment screen and take a look at how they're currently invested. Right now, they're at roughly a 90% stock, 10% bond allocation in their portfolio. And that vast majority of that money is right in the domestic or US market. That's a very aggressive allocation for people who are 2 years away from retirement. But it's honestly not that uncommon. The first thing we would want to do is shift them to a more conservative portfolio, one that would match their risk tolerance and their need to take on some risk for a successful plan. So going into retirement, it's a good idea to have 3 years worth of expected portfolio withdrawals in low volatility, stable assets, cash, or short-term bonds. Now, everyone's comfortable with a different amount, but I like 3 years because historically, average bear market lasts about 9 to 10 months. It takes about 2.5 years to get back to the full before the drop high prices. So having 3 years of spending set aside in cash allows you to have a buffer to ride out an average downturn in the market. Now, we want these funds to be in low risk assets like cash or short-term bonds. And we don't want to take a giant 401k distribution for the Millers and create a massive tax bill to fund it. So instead, we can use their taxable brokerage account and strategically rebalance their 401ks to provide them that buffer over the next 2 years before they retire. Now, if we go over to roughly a 60-40 portfolio, that would put a little bit over $700,000 in low volatility assets. Now, right now, you can see their glide path is set to none. So I'm going to switch over to a customized glide path for the Millers here. Indicated in orange, we're going to have a larger cash balance in their overall portfolio, with the remainder being allocated to that roughly 60-40 portfolio we set up for them. Now, as we move past the age of 70 here, you can see that orange section for the cash allocation starts to decrease because we're expecting a lower amount of withdrawals to come out of their portfolio during these years after Social Security starts, right? And then finally, once their RMDs start and they're forced to start taking money out of their accounts, then the cash allocation of the portfolio can return to the core portfolio setup. Now, by delaying Social Security till 70, they're going to be leaning harder on these portfolio withdrawals during the first 6 years of retirement. That's fine if the market grows, but if it doesn't, that's where the cash buffer comes in. They have stable assets to weather that downturn without panic selling. And they also always retain the option to change their Social Security strategy and start claiming a little bit earlier if things change in their life. The key is having options. I did a deep dive on Social Security claiming strategies in a recent video. I'll put a link on the screen for you if you want to watch that one. Let's quickly go back to their success meter in the plan here. Let's take a look at where they are and what these changes would do to their overall plan. So we're going to change a few things. Remember, they were starting at a 70% probability here. I'm going to update their portfolio to that more conservative allocation, and I'm going to go ahead and turn on their glide path. Other than that, one more opportunity we saw in their plan was just to max out these 401k accounts in the final years that they're working. They're currently at a 22% federal rate, and we're expecting them to withdraw at a 12% rate. So that 10% arbitrage there, that's definitely worth it in my opinion for the Millers. Let's hit refresh and see what happens to their overall plan. All right, look at that. We're up to 86% and a significant increase in the ending assets of their plan. But what I really want to see here with you is what happens now with this proposed situation if that market takes a 20% dip. So let's head over to that stress test screen. And then this time we're going to run that test against our proposed plan with the new allocation and glide path. You can see here without the market crash, we're up near 86%. And then even with a market crash before or after retirement, we're up above and near 75%. So compare that against the 54% we saw in the original plan. That's the power of building the sequence of returns protection into a retirement plan. You certainly can't control what the market does, but you can build a plan that's resilient to bad timing. So what's the bottom line here? Well, thanks to the work of researchers like William Bangan, we know that sequence of returns risk is a real peril for retirees. It's about building a plan that's resilient enough to handle bad luck. For Stan and Mindy, that just meant diversifying into a more conservative allocation before retirement and including a cash buffer in their plan to avoid selling stocks during any market downturns. They're going to delay their Social Security to maximize their income floor and stay flexible if the market doesn't cooperate. These strategies, they're not going to eliminate risk entirely. There's nothing that can do that. But they can dramatically improve the odds of a successful retirement, even if you happen to retire into a bear market. Now, if you found this helpful, make sure to hit subscribe so you don't miss future videos where I break down retirement planning scenarios just like this one. And if you're getting close to retirement, you want to make sure you've thought through every detail, I've got a free checklist for you. It's things to consider before you retire. You can download it using the link in the description. Thanks so much for watching. I'm Jordan Drinkhouse, and I'll see you in the next one.